Hello, everyone. Today, we'll cover a very important topic in corporate finance, which is understanding how to value stocks and shares. The objectives that we will cover in this topic include understanding shares as a means of investment, to understand stock prices and how they depend on future dividends and future growth, followed with how to perform stock valuation using various methods. Think of investing, and what comes to our minds? Stocks, shares. Exciting, isn't it? Yes, stocks have been one of the greatest tools ever invented for building wealth. We do hear stories about people making lots of money simply investing in the appropriate stocks. But it's important to remember that investing in stocks do not come without risks. People become wealthy on one side, and on the other side, some do lose a lot of money if they don't make the appropriate decisions. So let's begin by understanding what are stocks. Very simply, a share is the ownership in a company. Stock represents claim on the company's assets and earnings. So anybody becoming a shareholder has a right to claim in the company's share of assets as well as earnings. And of course, along with that, shareholders have voting rights. They have voting rights to participate in the decision-making process attached with the stock. More the stocks you own, more would be the voting rights to participate in annual general meetings for decision-making. So we see shareholders have rights. They have a right to the assets, they have a right to the earnings, as well as right to vote. But on the other side, there are risks. There is no guarantee that the shareholders will be paid dividends because there is no obligation on the company to pay dividends to the shareholders, whether they earn profit or not. Dividend earnings from the dividends is one part of returns that the shareholders can get. On the other part, shareholders could also make money if the stock price appreciates. This is on the positive side. On the downside, any stock or any company may go bankrupt. In that case, neither dividends nor getting your capital money invested back could be a major risk. But taking on this risk demands a greater return. What we have seen historically in capital markets is these investments generally outperform other investments like bonds and savings account. It goes down. So we wonder what causes the stock prices to change. The straightforward answer is yes, the supply and the demand. So when the demand of a particular company's stock increases, investors run to buy those stocks and the prices shoot up. On the other side, when supply is more than the demand, then in that case, the prices have to suffer. Now, supply and demand is a very straightforward concept. Behind supply and demand, what is hidden, what causes the stock price's demand to increase and decrease is what we need to understand. So the share prices are basically governed by number one, priority is investors' perceptions. What do investors feel about a stock determines the demand for a particular stock. If investors are confident that the stock prices of a particular company is going to increase, then the demand will increase and the share prices will shoot up. On the other hand, when there is any bad news in the market related to a company's performance, related to company's reputation, suddenly you will see that people or investors sell off the shares. And when they sell off the shares, supply in the market increases, bringing down the stock prices. This is the immediate impact that markets see of investors' perception on share prices. Investors' perceptions are also governed fundamentally by the growth and the earning prospects of the company. So when a company's management comes out with interesting news about growth, about earnings, about dividend declarations, you will see that the demand for the particular share increases. So yes, supply and demand is straightforward in understanding the changes in the price, but hidden behind supply and demand are multiple factors that determine why the stock prices change. Buying the shares at the right prices has always been priority for investors. We say buy low and sell high has been the best tactic ever for growing your wealth. But how do we estimate or judge the share prices in the future? That is a challenging area. The area of finance gives us multiple methods to value stocks, so companies. So when we talk about comparables, is we compare certain ratios or certain multiples of one company with its benchmark or the best possible competitor. Let's take an example here about valuation by comparables. So we compare certain ratios. Here the ratio that we select is market to book value ratio. That is market price of the share divided by the book value of the share. When we say market price of the share, it means the current share price in the market. And book value of the share is the stock value in the balance sheet of the company divided by the number of shares. So that is the book value per share. So let's take an example here of certain companies. We see Johnson & Johnson having a market to book value of 3.4, whereas the competitors having a market to book value of 3. Just by visualizing and comparing Johnson & Johnson's market to book value with its competitors' book value, we can determine that Johnson & Johnson is overvalued compared to its competitors. Let's look at PepsiCo. PepsiCo is 6.4:3. This is very highly valued compared to its competitors. Okay. Let's take an example of Dow Chemicals further down. Dow Chemicals is having a market to book value 0.5, whereas its best competitor in the same industry is having a market to book value of 3. What does this indicate? This indicates that Dow Chemicals is undervalued in the market. That means its share prices is less than that of similar companies. Now, there could be multiple reasons, and when we investigate during this time period, why was Dow Chemicals share prices down? It was related to a certain reputation issue, a certain information in the market that brought down the value of the shares. The supply of the shares in the market increased. So, valuation by comparables is one of the ways in which we can quickly understand whether a particular company's share is overvalued or undervalued in the market. Many a times, an undervalued share becomes a good buy, expecting that the share prices would increase in the future. Comparatively, when we look at PepsiCo, it is quite highly overvalued. Now, overvalued companies could have multiple reasons for their share prices to be quite high compared to its competitors. It could be either that the company is having exceptional growth prospects, and it would then be advisable to make a buy decision in this regard. So valuation by comparables gives us an idea whether a company's stock is either overvalued or undervalued. Connecting it with other factors, other macroeconomic factors, business related factors, investors can then come to a buy or a sell decision. Before we go into the robust intrinsic share valuation method, let's understand the concept of expected return. Expected return is expressed in percentage term. So it is a percentage yield that investors forecast or expect from a specific investment or a specific stock of a company over a particular period of time, also known as holding period return. So if we need to denote expected return or R, it comprises of two components. One is the dividend gain, and second is the expected change in price over a period of time. So expected dividend in 1 year's time, P1 minus P0 is the expected change in price over 1 year divided by the existing price. The expected rate of return formula is therefore broken up into two returns. One is the dividend gain and the other one is the capital gain. We could also denote it in simplified form, the dividend gain divided by R minus G. G would stand for the growth rate. The growth rate is the capital gains. So we try to understand expected return, which is connected to a particular stock, a particular company, which comprises of two components. One is the dividend gain from that particular stock and the expected capital appreciation of the share prices on that stock. So when we use the intrinsic method of valuing stocks, which is considered to be a robust or a method of knowing the true value of the stock, basically what we are trying to do is adjust the expected return on a particular stock, compare it with the market returns. Market returns, in other words, is known as the required return. So when the expected return on a particular stock is less than the market returns, what the normal market would provide to an investor, then in that case, investors would sell the stock. On the opposite side, when the expected return on a particular stock is greater than the market return, then investors would then run to buy the asset and drive the prices. So let's look at the stock valuation method. One of the intrinsic methods is the dividend discount model. A couple of assumptions that we need to understand before we dive into the model is that in this particular model, we expect that the dividends are paid annually, which is a common practice, and the first dividend is ideally received 1 year after the equity share is bought. So investors may decide to hold shares either for a short period of time or for a long period of time. So they are short selling or they keep it for a longer period of time. Let's assume here that the investor expects to hold a share for 1 year. Now, what would be the expected price that he would be willing to pay for now, given the assumptions that he expects a particular dividend from that particular share and the price of the share after 1 year? So here we have different variables. To evaluate what would be the true price of the share now, we need to know what would be the expected dividend after 1 year and the expected share price after the year. So we use the dividend discount model, which discounts or brings the future value of expected cash flows from that particular stock to its present value. So when we discount the present value of future cash flows, in this case, the future cash flows being the expected dividend and the price that the investor will get for the share after 1 year when he wants to sell it, we discount it by the investor's required rate of return. That is, what would the market give him after, what is the market expected to give him during this period of time, the rate of return, which is the required rate of return. Let's illustrate this single period valuation of stock prices with an example. So prestigious equity share is expected to provide a dividend of 2 after a year and fetch a price of 18 a year hence. So that is the assumptions that we have come up with, that after a year you're expected to get $2 dividend and $18 for the share that you will sell after a year after. What price would it sell for now, or what would be the true value of the share now if investors require a 12% return on similar stocks and similar companies? So we plug these values into the model where we have D1 at 2 and P1 at 18, and we discount them by 12%. So D1 divided by 1.12 and price of 18 divided by 1.12, that gives us the true value of 17.86. That is, that gives investors an idea that the true or the intrinsic value of this particular share at a given point of time, which is now, is equal to 17.86. So if the share is selling for more than 17.86 in the stock market, it is not a good buy because eventually the price will drop down to 17.86. However, if the same stock is selling for less than 17.86, let's say at 16 or $15 in the market for whatever reason, then it becomes a good buy. You buy low, expecting